to the RISE lecture. This is the fifth in a series of lectures that was inaugurated in 2015. And it's an opportunity for us to bring to campus Nobel Laureates in economics to share their wisdom with us. And it's a fantastic honor to be up here today and introduce our speaker. The RISE lecture series was, as I said, inaugurated in 2015. It is co-sponsored by the RISE Initiative for the Study of Economics, the Office of the President, and it was made possible by a generous gift by our alumnus Doyle Arnold, and we are delighted to have Doyle with us here today. Thank you, Doyle. Today's speaker is Vernon Smith, who is the George Argyros Endowed Chair in Finance and Economics at Chapman University. Dr. Smith completed his undergraduate degree in electrical engineering at the other institute, Caltech. I think Rice grew into a university, and he did a master's degree in economics at the University of Kansas and his PhD in economics at Harvard University. Prior to moving to Chapman in 2008, Professor Smith taught at George Mason University, University of Arizona, Brown, Purdue, among many other prestigious universities. During his illustrious career, Professor Smith has received many honors and awards, including in 1995, the Adam Smith Award conferred by the Association for Private Enterprise Education. Professor Smith is a distinguished fellow of the American Economic Association, a member of the National Academy of Sciences. The list of awards is way too long, and it would take the better part of today's lecture. So instead, we should really focus on the phenomenal contribution that he's going to share with us. In 2002, he was awarded the Nobel Memorial Prize in Economics for his groundbreaking work in experimental economics. And if you allow me, I would like to share a little anecdote. I actually met Vernon in 1990 when I was a graduate student at NYU, and early in my career I was entering and exploring the field of experimental economics. And I remember we had a conference in Tucson, Arizona, where it then became this annual event of the Economic Science Association, the ESA. And what was memorable about that day was not only the brilliant mind that we all saw and the genius that was obvious throughout the day, but then when the conference was over, Vernon said, I would like to invite you all to just a little small gathering, and we're just going to go have a beer, have some fun. And he took us to the wild, wild west in Tucson, Arizona. And then we saw that not only is Vernon a brilliant economist, but he's probably the best country line dancer I've ever seen in my life. And without further ado, please help me welcome Vernon Smith.
Well, thank you. Thank you very much, Antonio. And thank you, Arnold, for endowing this. It's a great, great pleasure to be here. I've been to Texas many, many times in my career, and so it's great to return. And, well, at my age, it's a pleasure to be anywhere. Okay. But I do want to say that this is special, and that I very much appreciate the invitation. All right. This talk was advertised as learning by proving yourself wrong. Well, this isn't a bait and switch. It's still the same topic. It's just that this title here gives you a little bit more of the content. I had two really quite major experiences in which not only was I wrong, but the economics profession was wrong. Okay, I had lots of company, and I convinced myself it was wrong. as a result of the experiments that I was doing in the laboratory. And so I'm going to talk about those, and I want to particularly emphasize that what we discovered was unexpected, okay? And then I want to talk about the insights that these two examples helped to give me and other economists for the broader economy. So that this has lessons in it that go much beyond the laboratory, but the basic foundation was laid in our studies in the laboratory. Okay, now here's two widely held and taught beliefs. There were theories, okay, in economics that were falsified by experiments. And the first, here for a general audience, for markets to serve economic betterment, and in economics that concerns supply and demand theory. But for markets to serve economic betterment, all participants must have complete knowledge of supply and demand. That's what we believed. It was believed that the competitive model was a very abstract ideal that wouldn't actually be likely achieved in the real world unless people had complete information. And you often had an analogy with of the frictionless world of physics, where the models may abstract from friction. And that was one of the common kind of metaphors that people used in teaching. We also believed that you had to have large numbers, essentially a sea of buyers and sellers, each one very small compared with the whole market for this to work. And that put them in the position of being unable to influence price, so that they were all price takers, okay. So, and when I started doing experiments in the 1960s, this was the predominant thing that you learned from all the pretty books in the in your graduate education, and you taught that, okay. And then the second shocker was that if asset value that we believed was that if asset value is known, and this has to do, we talked about transparency, price bubbles will not occur. The idea is it was the incompleteness and imperfection of information that sometimes created price bubbles out there in the world. Okay, we're going to examine lab experiments falsifying these beliefs. And then I'm going to demonstrate how the contrary results found in these two kinds of market experiments relate to the performance of the broader economy, and particularly its sources of stability and instability, okay? Okay, first, false beliefs about participant knowledge in markets, or the requirements of knowledge in markets. This claim originated with William Stanley Jevons. William Stanley Jevons was a very prominent English economist, and he first wrote and published an abstract of a mathematical theory, general mathematical theory of supply and demand, in 1862. Interesting, because my first experimental economics paper was published exactly 100 years later. I didn't know that he had done the work in 1862. In fact, I thought it was later in the 70s. But here's a quote from Jevons. He says, "A market is theoretically perfect only when all traders have perfect knowledge of the conditions of supply and demand and the consequent ratio of exchange," in other words, prices. Now notice here that Jevons thinks about markets from the perspective of his model, okay, not that of the participants in a market. He has a model in mind of what participants achieve in markets, and
and so he doesn't have a model of what people would actually do in markets, or what people, how they look upon their world, okay, and from their perspective. So kind of the false implication is that market participants must have the knowledge of the theorist, because that was his model. He tended to interpret, you see, what he sees out there in the world in those terms. And that distinction is very important, because as abstract theorists, our work is often better at modeling what it takes to get efficient, welfare improving outcomes, but we're not always that skilled in looking at it from the perspective of the participants in the market. Well, for me, experimentalism, experimental economics changed all that, you see, because I had to come to terms with what people are doing in these laboratory environments. Now, most of you have witnessed an auction. I want to start out here with something that you probably can all relate to. If you've not been to an auction, you've seen an auction on television or something, and you'll notice, so there's an item up for sale. It's an antique, it's a painting, or it's an antique piece of furniture. It's a farm tractor or whatever, and it's up for auction. And notice that, and the buyers are bidding, okay? And when the bidding starts out, there's lots of hands up. There's lots of people wanting to bid, okay? Then the prices start to rise, and as the price for that item goes up, you'll get fewer and fewer hands raised. And finally, there's just one bidder left, and no one raises that bidder's bid, and the item is, as the auctioneer says, knocks it down to that guy or that gal, okay? And it's over. Well, notice here, you see a demonstration of the law of demand, okay? People want to buy less when the prices are higher. And also, as the price goes up, people are dropping out as if, well, they have a value. They have a most they're willing to pay. And when you reach that price, they drop out. Well, that's exactly the way I did my first experiment, okay? I just take that example. Except my experiment was two-sided, both buyers and sellers, and the sellers each had a unit, okay? So many copies of this item that's up for sale, okay? So I want to show you the two-sided auction with both buyers and sellers bidding, and there's multiple units, and we call this bid-ask market a double auction, okay? And one of the things that came out of this experiment right away is that prices converge quickly to equilibrium. But no one in the market knew anything about that. Each person is like in that auction, each person has got a maximum amount they're willing to pay, but doesn't mean that the person knows anything about what other people are willing to pay. So this is exactly the kind of the circumstance that I created. And I'm going to show you a recent experiment and then some very early experiments that I did back at Purdue University, which is where I started as an assistant professor in 1955. Okay, here's, in this market there are 6 buyers and 6 sellers. Each have been assigned, the buyers each have been assigned several different values, okay? Each of the sellers have been assigned several different values, call them costs. They have a unit, and the values we assign to them represent the minimum price at which they're willing to sell that rather than keep it. And the buyers, you see, have a value that's been assigned to them. And that represents the maximum amount they're willing to pay. Now, we motivate buyers by paying them in cash. They earn cash payments equal to the difference between the private value they've been given and the price that they pay in the market when they buy it from some seller in the room. The seller gets the difference between the price at which he sells the item and his private value or cost for it. So the buyers are motivated to buy low. The sellers are motivated to sell high. And nobody knows anything except their own values. So this was precisely the conditions which Jevons would say you're not going to get an equilibrium in that market because you don't have complete information. And what you see here, this is a bid-ask market. So over here on the far left, you see a buyer there starting out and bidding, it looks like at $320. And then a new bid has to be higher than the standing bid from a buyer, just like in that auction of the painting, okay? A new bid has to provide better terms than the last bid, the standing bid, except in this case, sellers are also shouting out asking prices. So there's a first ask price here up over $8. A new ask has to be lower than that. So you see here the bids and asks coming in, and they converge. They tend to, the bid-ask spread tends to narrow. You get a contract by either the buyer accepting the standing ask of a seller or the seller accepting the standing bid, the highest bid of a buyer. And then as soon as there's a contract, the auction for that first unit is over, and you start a new auction for the second unit. So that's the process. And what you see here is the black line is just connecting the contract prices, okay? And over here on the right, you see that buyer 1 bought from seller 5 at a price of $6. That means that buyer had a value higher than that, and I now owe him, suppose it was 8, I owe him $2. And if the seller suppose his value is $3, I owe him $3 because he sold it for $6. So you see how that works, okay? So each of these, the subjects in the experiment are operating privately, you see, and they have a schedule here for these values, and they're keeping track of the prices and then computing their profits. It's an oral outcry auction, and someone is typing the bids and the asks into the computer while people are in this oral auction process, and everyone in the market sees these posted prices also. Okay, now these were high school students. We do in the summer we do 1 week workshops for high school students, introducing them to economics by using experimental methods, okay? And they're great subjects. Notice here this market stops with 12 units being traded. Okay, now this is a teaching, not a research exercise. So after they've finished, we then show them the supply and demand. And here's the supply and demand, okay? The demand is each of the 6 buyers have 4 units. You just sort those from highest to lowest, regardless of ownership. And you do the same thing with the values or costs that have been assigned sellers, and you sort them from lowest to highest. So that's the theoretical supply and demand. And notice here that up at the top there it says efficiency is 100%. That means they earn the most money that they possibly can, okay? And efficiency is measured very simply. It's what they actually are able to collect divided by the maximum they can. And here they collected the maximum. So we have kind of simple measures of performance in this market. I want to point out one other thing. You'll notice these prices are tending to converge from below. The bids, the prices are a little bit below that market clearing price up there in range, around 640. They're a little lower than that. That means that buyers, this is a completely symmetric design, so if everyone traded at the equilibrium price, the buyers would make exactly the same amount that the sellers do. But because these prices are a little below, buyers are actually doing better than sellers. That's the way almost all of these markets work. Buyers do better than sellers. It has nothing to do, I mean, they just manage to do very well. If you ask participants in the market, if you do a survey, and if you ask the buyers, do they think, who do they think did the best in these markets, buyers or sellers? They believe sellers do better. Okay? Almost everyone in the world thinks that sellers are very good at price gouging, right? Turns out buyers are very good at protecting themselves. And you see this demonstrated in this experiment. Okay, let's go back to January 1956. And I'm at Purdue University, and this is the first experiment I did. In this case, each buyer has 1 unit, each seller has 1 unit. And I did not expect this to converge. You see, I thought this was going to show that Jevons was right, that if people didn't have complete information, and nobody did in this market, it wouldn't converge. So my first question was, what's wrong with the experiment? And I thought, oh, it's the symmetry. Okay, completely, you know, it's an accident of the symmetry that the average value, the average cost, and the equilibrium price are all the same. So after that, I did some asymmetric cases, and here's a typical example. Here the demand is very flat, the supply is very steep, and prices start below the equilibrium, but they converge very quickly, so that virtually all of these experiments would be home by the 3rd or 4th trading period, even though these markets are very thin. Not many people in them at all. Okay, now this was completely contrary to kind of accepted microeconomic theory at the time in the 50s and 60s. Equilibrium was defined given demand values and supply costs, but economists, and this began with Jevons, had not satisfactorily articulated what we now call a message contract trading process, showing how people might explore opportunities and discover prices. That's all happened since the middle of the last century. And now, it's interesting because this contrasts with Adam Smith. If you go back and read the Wealth of Nations, his first axiom is what? It's the propensity to truck, barter, and exchange. His conception of a market is that people have this, and he doesn't try to explain where that comes from. People have this incredible propensity to truck, barter, and exchange and trade. Well, if people have that, then you get a price. As soon as there's a buyer and a seller that want to trade, you get a price. Those prices, as soon as there's a price out there, people can make calculations they couldn't have made before. You're growing corn and you're growing hogs, okay? There's a price of corn and a price of hogs. And you can ask yourself, well, wait a minute, at these prices, I think I ought to grow fewer hogs and more corn. Okay, so at the margin, people are starting to make decisions, and specialization is something that's discovered by a process in classical economics. Well, with the neoclassical revolution of the 1870s, included Jevons and Walras and Menger, equilibrium wasn't just added to that process thinking, it displaced it. you see. It displaced it, and we started to think of markets always as involving, you know, these equilibrium, but we didn't have really good ways of describing the discovery process. So from there, now, experiments really enlarged our exploration. It gave us kind of a new vision in many ways, and it helped to kind of relearn what the classical economists had talked about, relearn process ways of thinking. And it was in that context, you see, that economics started to become experimental and started to, and brought in equilibrium concepts and also processes and ways in which mechanisms whereby people might actually find these ideal states. Well, then, this then jump-started just a cottage of industry. Okay, people started doing experiments, and there's lots of low apples to pick, okay, with this new way of thinking. And people varied information. They varied the trading procedures. This is I showed you a bid-ask market. Well, but people started to look at how about ordinary retail markets, because there the seller posts, I'll take or leave it price. So we did experiments where sellers would independently post prices, and then buyers would queue up to buy at those prices, and then they would post new prices and so on. Well, those converged too. The main thing is that they took longer than the bid-ask market. So, and they might be more sensitive to very small numbers compared with the bid-ask double auctions. And of course, people varied numbers, small and large, firm sizes. They looked at markets with very large firms and some small ones. All of this started to come in. And then we also moved into applications. So my first experiment here in 1956, 25 years later, we are starting to do making markets in networks. For example, electric power networks, natural gas networks, pipeline networks. Did a number of studies for the Federal Energy Regulatory Commission in the United States. And I and one of my colleagues were involved in the liberalization of electric power in New Zealand and Australia. This was in the 1990s, early to mid 1990s. And what was neat about that is all kinds of people believed that you couldn't organize the electric power industry with markets. It has always been it was regulated in the United States. Outside the United States, it was government owned, okay? Almost all national governments, or in some cases states, own the electric power industries. Well, so what led to the liberalization movement? Very simple. The treasuries were hurting. Margaret Thatcher sold privatization of electric power because to help the British Treasury. They were losing money. And so they moved. That was the main motivation for the privatization movement that was at that time occurring outside the United States. And so the neat thing about the laboratory experiments is that we could take people in government and industry, say in Australia, and put them in these market in a laboratory demonstration. And then then there would be skeptics among them. We would ask them, okay, you don't think this can be done? How come you did it? And we show them the results, you see. So you get people's attention, you see, when you can when you can do some kind of demonstration like that. And the Australians, then they created a very ambitious laboratory experiment. It was their own southeastern grid, okay? And they started making markets in the laboratory with a system that had their generators, their electric power grid, all the same parameters in it, so they could actually try it out before they tried to fly it. Okay. Okay, now I want to notice very carefully here that all of these above experimental markets, including electric power, as well as the examples I gave you in the lab, they are for non-durables. Notice that a trader in the experiment knew before he or she went to market whether they were a buyer or a seller. Okay? You could not resell a purchased unit. You could not switch buyer-seller role, depending upon the price. Well, most of the products out there in retail markets are exactly like that. You cannot, you don't buy a hamburger to resell it. You don't get a haircut to resell it. You don't rent a hotel room with the idea of reselling it. That's exactly, and if you take GDP, total gross domestic product, subtract out government expenditures, that's your measure of total private product. 75% of that is stuff that people can't or don't retrade. It's consumption. Okay, so now, how are markets for durables different? Okay, so these non-durable markets work great in the lab, and it's a big, big part of the national economy. So now let's look at durables. And that involves my case too. The false belief that transparency, complete information in asset markets will prevent price bubbles. Okay, we decided to study asset trading, and this was in the early 1980s. I was at Arizona. We were now, all of our experiments were on computer systems, so that when you recruited people to the lab, they each had a monitor, and they communicated and they participated in the experiment through the monitor and through the algorithms or software that controlled the experiments. And so our idea was to create a baseline with no bubbles, and then explore conditions that would enable us to create bubbles. That was the plan. But as is very common in science, we did not know what we did not know. The baseline bubbled. Totally unexpected. And then we rephrased the question, the instructions to try to make it clear. We did a number of things. They were doing what they wanted to do. Okay? So, here's the environment. Pretty simple one. You're getting an endowment of cash and what's called shares. And you're going to trade in each of 15 periods, looking ahead. Okay? And at the end of each period, a drawing is made, and the drawing is either 0, 8, 28, or 60 cents, and they each occur with equal chance. Whatever numbers of those come up on the draw, if you have 5 shares in your account, and the drawing is, say, 8, then 5 times 8 is 40, and 40 cents is paid into your account. So that's the yield on the number of shares you hold at the end of each period. Now notice here that the average or expected value is 24 cents. So in the first period, you're trading something that's looking ahead to 15 draws. So before the end of that first period, you're trading something that has a holding value, a fundamental value, you see, of 24 cents times the number of periods, 15, which is $3.60. the subjects are all told that. And we explain all that so they know the first period is $3.60. At the end of the first period, they get their drawing, and just before they go into the second period, they are reminded, okay, the holding value, the dividend value of this is 24 cents times, and now there's 14 periods left, okay? So we really lean on them, okay? They don't pay any attention to that at all, nothing. If you think subjects are easily influenced by what the experiment wants, this clearly shoots that idea down, okay? So anyway, here's a typical inexperienced traders, and let's see, I think there's 12 traders in this market, if I recall correct, and I've only plotted here the mean prices, and the numbers is the number of trades in that period. So there's quite a bit of noise in each period, and I've only plotted the mean. So here they go. It starts out way below the fundamental value. It goes up, and remember, each period they're being reminded what the fundamental value is. And so it goes up, and then it comes down to the falling fundamental value, and it goes right through it. Goes out, and typically with inexperienced subjects, this market turns sometime between about 10 and 14 periods, okay, and then crashes. Notice here it's right back down to 24 cents at the end. Okay, bring those same people back a second time, and what you're seeing here is see, here's the first one that I just showed you. And then they come back a second time. Notice the prices are higher now. And here it is turning before this one and crashing. And now it's staying pretty close to fundamental value here the last several periods. Bring them back a third time. Okay? Same environment, same subjects. They read the same instructions. Okay? And now we're getting, for one thing, less volume. There's very little trading. And even several periods here where there's no trading at all. It just closes with a bid-ask spread and no one traded. So, talk about learning. Here this was completely unexpected. The original plan was to see if we can create bubbles. Now the plan is to see what we can do to get rid of them. Okay. Okay, one thing, these are undergraduates, and of course people will tell you, what do they know? Okay, what would happen out in the real world? What would real people do? I don't know why they don't think undergraduates are real people, but anyway, this is what you get. So this, naturally, we were interested in knowing how robust this was. And so we would bring in, I remember there was a guy, I was at Arizona at the time, University of Arizona, and there was a member of the Kiwanis Club who had read about our experiments. And so he came in and he says, hey, you know, would you do some experiments in the evening if I brought in people? I said, yes. So and they're mostly small business men and women, you see, in the local community. So all of the experiments I'm talking about, we did on them too. And of course the supply and demand experiments converged and the asset markets bubbled, okay? So now I want to show you, though, two examples. One is what over-the-counter stock traders did. We went to Chicago in 1988. I had a friend up there who recruited some over-the-counter stock traders. We said, we'll put them in one of these. And then we did, I don't know, dozens of experiments with sort of middle-level corporate executives at the University of Arizona. Well, here's the over-the-counter traders. Unknown to me, they knew they were going to be paid in real cash, whatever they earned. So, but they didn't know anything about what the experiment was. But they agreed among themselves that whatever they each earned in the experiment, they would all give it to whoever earned the most. So they decided, they basically made a contest out of it. And because these were sophisticated subjects and traders, we pulled out all the bells and whistles. They could buy on margin and they could sell short. So it wasn't just a cash market. So all of those were in the program, that capacity. So we pulled them all out. Well, there was almost no trades below. None of the means were below. They just really moved that price up. But the prices you see are rising relative to fundamental value, so we have a pretty clear bubble. It doesn't converge all the way for the simple reason they had their short positions were rising here, and we had a rule that they had, if they didn't cover their short position, they had to pay $1.80. That's 1/2 of the fundamental value of 360. Okay, that was our rule. So what happened is it'd come down and they were covering whenever at 180. So it kept it from coming back to equilibrium. And of course, short selling works fine, providing everybody gets it right. Okay. Okay, and then here's the Arizona Executive Asset Market that we did, I think, and we did quite a lot of these, and they varied all over the place. Some of them were big bell-shaped bubbles, and some of them were sort of flat with caving in at the end, and so on. Okay, and then we turn to a simple mathematical model of this phenomena, and we just postulated two kind of forms of investment sentiment. One, fundamentalists, and we modeled those as buying. The postulate we made was that they buy in proportion to the discount from fundamental value. So if the market starts out below fundamental value, they're in there buying in proportion to how much it is below. Okay, and then if it goes up above fundamental value, we postulate they sell in proportion to the premium. So they're just strict rational fundamentalists. And then we postulated momentum investors. These guys buy or sell in proportion to the rate of change of price. They're just watching the price. If it's going up, they're buying. So now this model predicts that if you increase the ratio of cash to share endowments, that will give you a bigger bubble. And the reason in the model is, who is it that runs out of money? It's the momentum traders. If there's a limited amount of money in the system, you see, then it may limit how much they can drive the price up. So if you endow them with more cash relative to shares, then this model predicts that that you will get bigger bubbles. So here's with a liquidity ratio of 1/2, that is, their cash holdings are half the value of the shares. And this is the same chart as I had before, except I'm plotting deviations from fundamental value. So it starts out below fundamental value, rises, peaks out, crashes, and so on. And then here's with the liquidity ratio of 0.75, and here it is 1. So we get this more money, bigger bubbles. Okay, now I want to turn to how these two kinds of markets are related to the national economy. And this is based upon my book with Steve Gerstad on rethinking housing bubbles. Now this chart is a chart of non-durable consumption. C, that's in blue. GDP, total output, is in red, and so on, those colored things. And they're all plotted as percentages of their values in the fourth quarter of 2007, because that was when the NBR, the regression. So you get all percentage deviations from that. So here's GDP is running about back at the beginning of the chart here, 2001. Okay, it's 16% below what it was, you see, in fourth quarter of 2007. So they're all plotted that way. Notice that GDP and non-durable consumption is just moving in step. GDP turns down, non-durable consumption continued to go up. It finally turned down some. That's a typical sort of behavior. Consumption doesn't, it may dip, but often doesn't really even turn down unless it's a major recession, as you see here. And we had that also, turned down a lot in the Great Depression. Durable spending, and that's mostly automobiles, furniture, that sort of stuff, durables consumer spending, didn't turn down until GDP did. Business investment didn't turn down until GDP did. The one thing that was already down, coming down a lot, was expenditures on housing. Quarter by quarter, expenditures on single and multiple family, this is new homes, okay? That started down early in 2006, and notice it fell 1, 2, 3, 4, 5, 6 straight quarters in a row, and then when it fell the seventh, we had a recession. Notice it didn't bottom out spending until 2009, and then rose. Anyone remember why that was? First-time home buyers could take an $8,000 tax deduction. I remember I spoke in Western Washington University about that time, and I said, what I'm very concerned about is that some first home buyers are going to grab that bait. I don't think these house prices have stopped falling. And all the evidence indicated that they hadn't fallen. Well, so you go out and buy a couple of $100,000 home because you've got this $8,000 tax deduction. You can lose that in 2 months, no time, okay? And so, in fact, you see, it did rise a little, then it was back. See, any stimulus in housing can only come from borrowing from the future. You're just moving that demand. You're producing something here that lasts, 75 to 100 years, and you're buying them mostly with other people's money. You see, you can't sustain, there's no way to sustain continued growth in that. And if you do and if you push it along and you're just borrowing from that future, and eventually, the tail's going to bite you. Okay. This is 90 years looking at housing expenditures as a percentage of GDP. And the bookends of this chart are the Great Recession here and the Depression back here. Notice the major decline in new housing expenditures in 1926, 7, 8, 9, whereupon the Depression broke in 1929, and that continued to fall until 1933. I was living on a Kansas farm for 2 years, 1932 to 34. In 1934, the bank took the farm, and ladies and gentlemen, that was good riddance. My father had got his job back in the city, and we moved back in the city. And I think back about that when I think of all of the people who stayed in their homes that were worth less than what they owed on it, and they stretched the loan from 15 to 30 years. They lowered the interest rate. You can stay in this home and pay it out, but you don't feel good because you've got that. You're carrying that, dragging that debt forward, okay? Stretched it out. Okay, I need to move along here. Antonio, what? Oh, yeah. I said I would take an hour, and here I am. And here's a 90-year view on where you're plotting GDP and consumption here on log paper. So now the log scale, so the slopes here give you the percentage growth. And all I want to point out is the little ripples up there in GDP that you see in this long-term growth chart are all of that what little volatility you see in GDP is entirely coming from things like housing. It's not coming from, look how smooth non-durable consumption is. That's just steady as, my first car was a Model A Ford. Model A Ford has a big flywheel. 4-cylinder, great big flywheel. You get it started, you can take 3 of the spark plugs off, and it'll run on 1. That's inertia. See the non-durable goods give the economy a huge amount of inertia. And all of the trouble, the instability comes, you see, from the durable stuff. And then, now this is interesting because it gives you, I think, some sense of the pain that followed the 2007 recession. This is Survey of Consumer Finances by the Federal Reserve Board. From 2004 to 7, look down here at the net worth, median net worth, and mean net worth. Median net worth rose by 18%. The mean 13%. Well, the median, you see there's many above as below. That means if that median is bigger than the mean, it means that those people below in the lower half of the distribution of wealth are doing quite well. So all of those housing programs, stimulus programs they were intended to help people of modest means. They were helping them. But it all ended in 2007. Look over here. In 2007 to 10, that group, the median, fell 39%. That means net worth position of families were going, the median was going clear back to, it hadn't seen levels like that since the early 1990s. 15 years, big hole, okay, in all these balance sheets. Steve Gerstad say we've had 2 balance sheet recessions in 90 years, the Depression and the Great Recession. None of the ones in between were balance sheets importantly damaged, and that's why we got out of those so quickly. Okay, here's total value of all home assets is the red line, and then debt, mortgage debt incurred to buy those homes, and the difference is home equity. Notice that home equity really collapsed because prices are coming down against fixed debt, and the debt, in fact, was still rising because there was some refinancing going on, and people still had some expectation that prices would recover. So equity really took this hit. And it's now, if you go out to 2017, it's almost up to what it was in 2007. Here's the same chart for the Depression in the 20s and the 30s. Notice here that equity, for one thing, notice that equity was actually fairly flat here in most of the 20s. It wasn't growing all that much. Well, prices didn't rise that much of homes. During the whole 20s, 20 or 25%. The home building was very elastic. We were able to expand building without there being a very much increase in prices compared with the Great Recession. But equity peaked out in 1929. It took 11 years for that equity to rebuild to what it had been. And guess what? In the Great Recession, it's taken 11 years. Almost everyone believes that we got out of this Depression because of of government spending for the war. But they draw the wrong conclusion from that. We also had, our balance sheets were repaired after 11 years. You can't conclude that the same spending that started, government spending that started in 1940-41 would have had the same effect if it had occurred back in 1929, because you had all kinds of broken balance sheets, okay, and people losing their properties and everything. So it took 11 years of repair and correction of that for it to start to really, okay. Now this will be my last slide. How about stock markets? Well, the lesson in this slide compared to the ones I just showed you about housing is that the stock market prices do not fall against fixed long-term debt. For one thing, people have more skin in the game. They have 50% margin requirements they have to put up. And moreover, the loan is a call loan. It can be called. If you get your broker informs you, you've got to put up more cash. If you don't put it up, he sells you out. So the balance sheets are cleaned up day by day. In the stock market crash, there's not that overhang, you see, to that shadow that causes all kinds of trouble in the future with regard, like with housing. Okay, here's a summary. The widely acclaimed success of this is not a summary, I'm sorry, this is an implication, I'm ahead of myself. I think this stability character of these two kinds of markets, you see, the one being quite stable, the unstable, helps to explain the enormous success, bipartisan success of deregulation of airlines, trucking, and railroads under Jimmy Carter. That was these are services. You see, these are non-tradable goods, and they're non-durable. On the other hand, there's been a lot of controversy about financial deregulation. That started, it was one of the last bills in the Carter administration, was to begin deregulating financial markets, and then that continued under Reagan. That's been very controversial. And I think it's much harder to get the property rights correct in those kinds of markets. Okay, supply and demand for non-durables with strictly private values converge to efficient equilibrium outcomes. Price discovery is a bottom-up trial and error process over time. In the economy, non-durables are a source of rock-hard stability. Prices in laboratory markets for retradable assets tend strongly to bubble relative to fundamental value. More money, bigger bubbles, and this helped us to see how houses bought with mortgage credit could contribute repeatedly to economic stability. So you learn the most by proving yourself wrong. Thank you, ladies and gentlemen.
So we have time for questions. I think we have microphones that can be passed around if anybody would like to ask a question.
So you said your challenge quickly became not how to create a bubble, but how to prevent one.
Yeah.
It appears that you never rose to the challenge. You didn't give us the answer to that. An answer.
More skin in the game.
More skin in the game.
I think it's pretty simple. Dodd-Frank is just horrendous. Piece of legislation, and it's directed at symptoms. You know, it's trying to prevent what they call predatory lending. Well, if you get an upfront fee for originating a loan, you're motivated to go out and push them, okay? And in our book, we have a simple proposal for loan origination fees. Whatever the market comes out of the market is the fee, but you have to distribute it over the life of the loan in proportion to principal. So in other words, if somebody wants to make an interest-free loan for 10 years, you get no fee for that until 10 years. So you just try to give people the loan originators, if that's to be separate from lending, and that's something for the market to decide, not me, at least give that originator of the mortgage the same kind of incentive the lender has. And I think you see that fairly simple rules that get at the incentive problems, the conflict between the incentives that individuals have, and what you'd like to see in society. That's the problem. And you see, long ago, we got that right for the non-durables. You know, you can't, we even have, for non-durables, we have truth in labeling, truth in advertising, devices to help, the kinds of information that people need to make good decisions. We got the property rights kind of well-defined for those kind of goods. But we're still having trouble with the stuff that you retrade.
I got one more.
Okay, hey.
First of all, on behalf of Bob Carter and myself as ex-bank regulator, bravo for Dodd-Frank is an abomination. I think Bob's signing vigorously.
We aren't in cahoots here. This is independent.
So for my own personal financial well-being, did you develop any insights into how to spot a bubble, in particular just before it breaks?
Well, one of the things that I didn't talk about, if I had a little more time I would, and that's the stock market slide I showed you. And what's interesting is that the Federal Reserve didn't understand that in 2005. The Federal Reserve had in April of 2005, after the Open Market Committee had met, they had a conference that lasted, I don't know, 2 or 3 days, and the question was, is there a housing bubble? That was the question in the conference. And several papers were given, and is there a housing bubble? Yes. And what is the evidence? Well, prices of homes have risen faster than the prices of all other goods. They've risen rents haven't gone up anything like the prices have, and actually the price, the ownership value ought to be related to what you can get by renting it, okay? So they had all these measures. Well, was it a big problem? Well, we could have some adjustment problems, but they indicated that they didn't see more than a 20% drop in the housing market. And how did they get that way? They looked at the crash in the stock market as a result of the dot-com bubble, which was huge in terms of the billions that came off of the value of stocks. And they said, we expect it to be much less severe than that. And they had their arguments for it at the time. Well, but what they were leaving out of the picture is that when house prices fall against fixed long-term debt, it's a much different animal than when stocks fall against short-term debt and the loans are callable. And it's just amazing. It turned out to be pretty embarrassing, you see, that because after they saw what happened, and of course and it's interesting, people, even early in the Great Recession, it was widely recognized that the problem was too much stimulus of housing. So what was the solution? More stimulus of housing, you see. Can't be the solution. Okay, thank you, Arnold. Yes?
Hi. How do you think that algorithmic learning involving the pricing system will affect economies in the future?
Well, that's, you know, a good algorithm is, if the market is being driven by momentum forces, a good algorithm will tell you to invest in that momentum. But it doesn't necessarily tell you when to get out. And and you see, it's if a market's being driven by momentum forces, you want to stay with it as long as you're pretty sure that that's going to continue. And and of course, people often will stay, and you see that but as it goes along, the whole thing becomes much more fragile and vulnerable, you see, so that it needn't take much to change expectations, and down she comes. And I'm not convinced that any of the algorithmic trading is going to help. I think finance, the whole finance industry has become larger relative to the GDP since about the mid-'80s. And I don't know what all the reasons for that is, but finance is part of the cost of an economy producing hamburgers, haircuts, and hotel rooms. That's not a final product, okay? Moving the money around is just a good thing to do only if it helps you to produce more output. And so when I go to finance conferences, I ask my friends, hey, where's all the output? The finance industry since the mid-'80s has doubled relative to the GDP. Now, if that is facilitating more product, where is it? You know, Bob Solow used to say, I see computers everywhere, but I can't find them in the GDP. Well, I can't find this. Now, it doesn't mean it isn't there. There can be measurement problems. I'm not claiming that it's not there, but I think it's an interesting question whether to what extent all of the new finance and the breakthroughs that have taken there, how much that has made the American economy more productive in terms of final goods and services that we all consume, okay? And we need more of if we're to eliminate poverty, okay? Anything else?
I just wanted to ask if all these conclusions give you any insight on the anthropology of economics, and whether this anthropology and people's behaviors have changed over time, since you gave us a 100-year perspective.
Whether these, I think that, well, basic behavior hasn't changed, but it's just so hard to get, you see, politically, following the Great Recession, the most important thing seemed to be who should we blame? Who should we hold accountable? One of the things they did was blame the banks, you see. We look for scapegoats rather than kind of the fundamental, where fundamental incentives of individuals, you see, have gone awry. And it's hard for politicians, for one thing, their constituencies don't necessarily understand all these issues. And so for a politician to take a more, what you might call a scientific stand is not necessarily a way to get votes, you see. So it's very hard to deal with that. And if you go back, you see, if you look at the aftermath of the Great Depression, you know, people were finding out where it was, what people did that was evil, and then how we can, you know, stop that. So there was all kinds of that sort going. Well, the horse was out of the barn now, and there's not much you could do. Although the learning, you see, and we did. I think there was changes made in the rules governing stock trading. We started to introduce the margin rules, and actually we started to amortize housing mortgage loans. See, in the 20s, they weren't amortized. Steve Gerstad and I found that 85% of the mortgage loans were, for one thing, just 3 to 4 years, and they were either interest only or only partially amortized, which meant that after 3 or 4 years, you got a balloon payment. So this is what was going on in the 20s. You get to 1929, and the housing market is a little bit soft, so banks don't want to renew those loans, you see. Anyway. So, if that helps.
One more question? One last question.
It appears that the size of the bubble is somewhat possibly correlated with the kind of the availability of credit. If you have more money to the players, they will drive the bubble
Yes.
up. My question is, like, have you ever studied the dynamics of really taking some money away from the players in the middle of the process?
Well,
At what stage you will pop the bubble?
I tell you what, we did finally. I didn't show you a slide for that one, but after several years of working with these laboratory experimental bubbles, we found a simple way to prevent bubbles with inexperienced subjects. That's when it gets started. You bring them back and they kind of expect a bubble. But with inexperienced, we declare the dividend, but don't pay it until the very end until the experiment's over. So there's no new cash coming into that market. We don't get the bubbles. We got one small one out of 7 experiments. So it's definitely the inflow, and that's important. That inflow of mortgage credit and the turns on that is a really very important fuel, I believe, for housing, making that comparison, okay? So that's why I think more skin in the game and would be very important, okay?
So we're going to move to a more informal conversation outside in the courtyard. Let's thank Professor Smith again.